Turning to the bond market, investors have been bailing out of bonds during the quarter. And in the municipal bond market, investors withdrew a record $4.5 billion from muni funds for the week ended June 26th. For the month of June, they pulled out nearly $10 billion. That's according to Lipper. So how should investors position their portfolios? Joining us now to give her perspective on the muni bond market, Natalie Cohen. She's head of municipal research at Wells Fargo Securities. Natalie, I know that you think that there are some screaming buys in the muni bond market, but I first want to start out with investors who already owned individual municipal bonds or muni bond funds. What should they be doing right now?
Well, you have to get back in a period of volatility like this to the fundamentals, which tell you to have a diversified portfolio, and that includes bond funds as well. You can have a shorter duration fund, a slightly longer duration fund. If you have all of your assets in a long fund and the fund sells off, then obviously you're going to take a hit. So you should apply the same fundamental strategy as you would if you were purchasing individual bonds and, laddering a portfolio, for example.
I mean, this is not, the rise in interest rates is not all bad news, I suppose, for people who own individual bonds, because if they don't sell them, they don't take a loss on them. And if you're buying new individual bonds, you're getting a higher yield. What would you recommend for the individual investor who wants income? That's all they care about. Should they buy individual muni bonds if it helps them from a tax-advantaged standpoint, or should they go into a fund?
Well, right now, this week, at the beginning of the week, there were some bonds. This was a very heavy volume week in the municipal market, and that's purely by coincidence, unrelated to announcements by the Fed and so on, that bonds got very cheap. And so retail investors saw the after-tax advantage of purchasing individual bonds. We would say, as far as those that hold funds, that it's extremely hard to time the market. You can't just say, well, I lost, I got to get out, because you don't know what's going to happen next week, next month, and so on. So yes, we all believe that interest rates are going to be rising at some point in the future. They have risen in the last 2 weeks. And have steadily. So, you need to position yourself with diversity in terms of length of time, shorter, medium term, and so on.
Natalie, you've been talking about the fundamentals of investing in muni bonds. And so I want to ask you this. As investors see headlines, some of the headlines are saying states have more surpluses. That's good news. But you also see the headlines of some cities that are having financial problems, like Detroit. What is the most important tip that you can give investors as they navigate looking for a muni bond investment besides just the yield?
Right. I think it's important to separate the credit issues from the market. Those are very different, and they tend to get blurred together oftentimes in the headlines. State general obligation bonds are very strong, including, for example, the state of Illinois, which has in its constitution that it has to pay the general obligation bonds. If you're a more adventurous investor and you want to go down the credit scale, what we see as stronger are what are called revenue bonds or dedicated taxes. Those they tend to be outside of bankruptcy. They're not affected by any kind of a bankruptcy.
All right. Well, thank you so much for giving
You're
us
welcome.
some insights in this complicated
thanks for your
market.
interest.
Natalie Cohen is head of municipal research at Wells Fargo Securities.
Great. Thank you.